Welcome, everyone, and thank you for joining. I'm Diamond Anabi, principal at SCG. I'm very excited for today's conversation because this topic is one that's often misunderstood or, frankly, completely overlooked, and that's marketing's role in SaaS. The discussion should take about 45 minutes, after which we will answer questions from the audience. To submit a question, click on the Q&A button at the bottom of the Zoom app. Today, we're going to do a deep dive on what it actually looks like to build a marketing function that drives growth. Marketing isn't just about branding or lead gen, it's about aligning your business around your customers, sharpening your message, and fueling scalable, predictable growth. I'm joined by Shiv Narayan, founder of How to SaaS and author of Exit Ready Marketing. He's helped dozens of companies unlock enterprise value by treating marketing as a strategic growth lever and not just a support function. Shiv, can you please introduce yourself and then we can get into this discussion?
Yeah, hey everybody, excited to be here. I run a firm called How to SaaS, like Damon mentioned, and what we do is we partner primarily with founders and private equity firms to help them scale their companies on the marketing side. So we do it in strategy consulting engagements, we do it through marketing due diligence, and then we also provide fractional CMO services. We've been doing this for about 6 years. And previously, I was a CMO of a software company called Wild Apricot, and we sold that to private equity, and that's kind of how I got into this space. And so what we try to do with our business today is help companies navigate that and get to a transaction or an exit by making their marketing function more sophisticated.
Great, thanks so much, Shiv. You can flip to the next slide here. Great. I'm going to lay the groundwork of what do acquirers look for and why. When we think about investments in M&A, buyers really love SaaS and software businesses because they're usually highly predictable. And that's why in this industry, we're seeing valuations that are far above any other industry. And this predictability in SaaS businesses is seen across the organization from the financials, the customer retention, win rates, tenured management, and the revenue engine. But as a lot of us know, and Shiv, obviously, sales is usually the hero where they're the ones getting resourced, they're driving the forecast, they're getting the board's attention. And marketing is often an afterthought. And I see this a lot in the deals that I work on and the clients that I work with. It's seen as tactical rather than strategic. And when marketing isn't aligned with sales, or worse, when it's just generating noise instead of generating pipeline, we see that companies aren't just leaving revenue on the table, but they're leaving enterprise value on the table when we get into a process. So buyers don't really care about, they do care about what you've done, but that's not the core of it. They care about how repeatable it is. So if the top of the funnel is chaotic and the messaging is unclear, or you're feeding bad fit leads into a machine, it doesn't scale. And buyers see that as risk. And they're going to reflect that in either how they're looking at the opportunity or how they're valuing the business. Go to the next slide here. So marketing is the way to build a predictable revenue engine. And when marketing and sales are working together, that's when companies are growing and they're growing consistently. And I've written about this before on LinkedIn and in blogs, but the one major difference I see between companies that are able to scale from 5 to 10 million plus and those that really stall at 5 million is the ones that scale have figured out their go-to-market strategy, and not just the metrics, but who to sell to, how to sell to them, and which ICP is giving them the biggest bang for their buck. So those that are nailing their go-to-market function are able to build that momentum and push past that $10 million in ARR plus and have successful exits. So Shiv, my first question to you is, why do you think marketing is so often overlooked as a strategic lever in SaaS and SaaS M&A?
Yeah, I think to answer this question, you kind of have to think about how companies start in the first place. Usually it's a founder or a set of founders that have earned an insight or a secret into a market, and they often have a ton of relationships. So the first go-to-market channel happens to be the founder's personal relationships or personal network. And then the company starts to scale that way. And then as the company grows, the founder inevitably replaces their different roles inside the business. And one of the first roles that they add are salespeople. So people that do outbound or account executives that are closing deals, or even account managers that are nurturing deals or expanding existing accounts. And theoretically, you can see a company grow to 10, 50, even $100 million where sales is the main growth engine of the business. And along the way, the marketing work, in quotation marks, is often relegated to more supporting mechanisms. This would be things like trade shows, sales enablement content, maybe doing some basic website work, doing some PR and comms work. But in general, the company's looking towards the sales team to actually be the rainmaker inside the organization. And marketing doesn't have these expectations put on it from the organization in the same way. And that's a bit of a problem because especially as companies have evolved in the last 20 years or so, and you think about what is necessary to actually drive customer loyalty, drive acquisition, a lot of customers are looking for content and ways to engage with companies beyond just the interactions that they have with salespeople. And the companies that have kind of figured this out have found a way to grow a lot faster. And so
Mhm.
one of the things that we kind of like to say is that your revenue problem is often a marketing problem because you might be investing sufficiently enough on the sales side, but you're not doing the same amount on the marketing side. So that there's a big chunk of the buyer journey that's kind of overlooked, and that leads to missing targets and not hitting quotas.
Yeah, that's a great point. And you talked about companies that are able to build revenue and revenue that looks strong on paper, but I've seen this too. When you look underneath the hood, the revenue is a bit lumpy and you're seeing that it's founder dependent or it's really unpredictable. So, in your experience, how do you evaluate whether a company's marketing function is actually creating value or if it's just keeping up appearances through that strong top line revenue?
Yeah, I think a good way to kind of think about this is to think about what percentage of pipeline and revenue is being driven by marketing efforts. And this is a simplified framework to kind of think about it is where on the x-axis you have the amount of marketing investment your company is making, and on the y-axis you have the amount of pipeline that's being generated for marketing efforts. And I would say most companies fall between stages 2 to 4, and I'd say even more fall between stages 2 to 3 where there is some marketing happening, but in general, most of the pipeline being generated, like I said, is being generated by sales. So if we were to measure that, it's sub 15%, even in a lot of cases less than 10%. And like if we kind of visualize it in a different way, you can kind of put these ranges across each stage and try to figure out where is your company in its journey or its sophistication level, and also how many team members do you have? Do you have enough people working on this problem to drive more pipeline, to generate more revenue for the business? And it can be a very quick diagnostic to figure out kind of where you are on the spectrum.
That's great. And you've mentioned this in your book, and I'm looking at your slide right now, that a marketing misstep and not following the general guidelines can be extremely expensive, and they're not always obvious to founders or those businesses that are growing and maybe seeing marketing as an afterthought. So things like weak segmentation, and you brought that up, a bloated CAC, noisy pipeline, they're all things that I've seen erode valuation and stall deals. I recall one deal specifically in recent years that I worked on that a client did have really strong growth and all the buyers recognized it, but my client didn't have the marketing data or the go-to-market data to articulate why they were winning. And they couldn't articulate how it was repeatable. And we saw a lot of buyers in the process effectively, drop out of the process or really poke holes in the story because we weren't able to support that story of the growth. We were able to get that deal done, a very successful deal in that space, but it was a little bit of a roadblock that we ran into because we didn't have that information. So, from your perspective, what is the number one marketing mistake that tanks enterprise value, even when the top line looks healthy?
Yeah, I think the predictability part that we've touched on is obviously one of the most important things. Is your revenue predictable? Is there a foreseeable pipeline that we can reasonably expect to close? Do we know how much revenue we're going to be making 6 months, 12 months, 18 months down the road, and what the growth kind of looks like? So I think that's more business level understanding your revenue growth metrics, your EBITDA margins, your gross margins, and things like that. And then if you take a step lower, beyond that, I think one thing I like to talk to founders about and companies about is just looking at some of your core business metrics and trying to understand where are you in terms of are your metrics healthy or not healthy? And I would say most companies that are ready to be sold or about to be acquired or worthy of a process often have quite healthy metrics across the board. Maybe they have really good CAC payback periods. Maybe their demo to operate or op to close rates are in a good place. Maybe their LTV is actually quite strong, or even their net revenue retention is often north of 100%. So when you have characteristics like that, and I would put that in columns 4 and 5 here as a way to kind of scorecard your go-to-market. It helps you understand how healthy your business is and how aggressive you can be with your marketing efforts. So if, for example, your net revenue retention was below 80%, you probably should not be spending any effort on the marketing side. You need to nail your product and who you're kind of going after. But if your net revenue retention is above 100%, but your marketing contribution of pipeline is, let's say less than 15%, at that point, you are kind of holding on to capital too much and you should be more aggressive because there's a lot more growth that you can capture just by investing that capital into different areas. So I would say this is not as much of a mistake or a deal killer as much as leaving value on the table. And then if you are able to invest more and show more traction, it translates into more enterprise value. And just as an example to kind of illustrate this, if you imagine a company that has a CAC payback period of 12 months, net revenue retention of 110%, and an LTV of 7 years. If every dollar you invest in year one for that business into marketing spend, if it translates the way we're saying here, by year seven, the enterprise value on that is 9x or 9 times what you initially invested because it grows over time and then your net revenue retention kind of compounds on top of the revenue that you're actually generating. So when you look at the math kind of like this, it becomes obvious that you should be investing more into this area, especially if the return from these efforts can get you more pipeline and revenue than some of the more traditional avenues that companies are accustomed to.
Great. Yeah, that's really interesting. When I was reading about this in your book, I was astounded because I knew it anecdotally, but to see it in numbers is really interesting. And you've brought up this point a couple times in just your talk track here, but going after the right prospects is really important. And we see it a lot where, and you have an example of this in your book, where budget, whether it's marketing budget or elsewhere, it's being burned on bad fit leads. How often are you seeing that happen? And how would a founder or an executive know that they're burning budget on these bad fit leads?
Yeah, I think, and I may need to jump a couple of slides ahead here to answer this question. And we'll come backwards in a second. Oh, excuse me. Yeah, right here. So I think one way to kind of think about this is to think about your different segments of customers. And a lot of the metrics that we discussed so far, if you were to kind of take your customers and segment them out by either vertical or by industry or by size of account or type of plan that they're on or by geography or whatever other filter you have to kind of analyze different segments, you're going to be able to find some customers that are a great fit for your business and some customers that are not as good of a fit for your business. And what you're going to find is that the ones that are a best fit for your business often have the best metrics across the board. They have the best close rates, they have the best gross margins, they have the best NPS, they have the best net revenue retention. And it's not that they might be good in some areas and not as good in others because they are actually the ideal fit for what you're selling. Yet, when we look at budget distribution, and how go-to-market budget is applied to these different segments of customers, companies often equally distribute that budget. So they'll focus just as much of their resources on landing a high fit account as they would on a lower fit account. And over time, this leads to a customer distribution that is evenly distributed across good fit and bad fit clients. And what you actually want is you want like 80 to 90% of your budget going towards your best fit customers because there's more than enough total addressable market out there for those best fit customers. The problem is that most companies have not done this analysis. So they wouldn't even be necessarily be able to tell you exactly who is their best fit customer. And even if they do know that, it kind of is a frightening thing to do to turn away business
Mhm.
that is coming in the door that you know is not a good fit, but at least it's revenue in the short term, in order to kind of win long term and have a better distribution of customers that you know will stay with you, would be promoters and have higher value long term.
Absolutely. And I love this because a lot of the work that we do at SCG is digging deep into the company's numbers and trying to figure out where there are efficiencies and where there are places that maybe you're not being as efficient. And I recall very early in my career that we worked with this business that we thought was horizontal in nature. They were serving a lot of different verticals. But we were able to look under the hood and see that there was two or three key verticals that were generating the highest ACV and the strongest retention. So before we launched, we had the client really refocus on those key verticals. And then when we went to market, they ended up transacting with the largest strategic in the space with a killer valuation. So just small tweaks and really understanding the numbers and who is your key and perfect ICP is so important, both when you're just running the business and when you're looking at strategic exit.
Yeah, totally. I think one thing I would just add to that is a business that's capable of being sold or worth buying is often a business that's not worth selling or might be worth holding on to.
Yeah,
So the things that you want to do to market your business so that you can eventually exit are often things you should be doing anyways because it's going to help you build a better company with better fundamentals, with better cash flow, with better financials, everything across the board. And I think along the way, as founders are building companies, there's just so many things to do that you kind of just keep expanding what you're kind of focused on, but narrowing the focus and narrowing the story, narrowing kind of who you're going after is the key to find success.
absolutely. Totally agree. So Shiv, in your book, you have a pyramid of marketing sophistication, which I think you have a slide on. So
Yep.
we can flip to that.
Yep.
I love this. Can you describe this at a high level for everybody that's listening in?
Yeah, I think a good way to kind of frame this is looking at the top of the pyramid. Like everybody wants this outcome of revenue growth. When we meet a founder, a CEO, or PE firm, and we ask them kind of what's your objective with this business, one of the first things that we hear is just we want to grow as quickly as possible. We want more leads, we want more pipeline, and we want it yesterday. And when you really step back and you think about what's required to actually generate more pipeline and more revenue, there are just so many layers of work that need to go into that. And I think that's often misunderstood. And so, what this kind of framework outlines is that you kind of have to build through layers of sophistication before you can reach that outcome. And level one is your foundational work. And that's some of the stuff that we're talking about. And this is where you have to nail your TAM and segmentation accurately and know who your ICP is and how big that market is and who's the best fit customer. Number two, you want to go into product marketing and make sure you have the right messaging, the right positioning, the right assets to actually communicate with that ICP. Third, you need to have the right sales enablement assets that help customers get nurtured by sales reps, and maybe there's battle cards, case studies, etc. Then you need the right go-to-market strategy to reach that ICP, and then you can kind of graduate into the programs that you want to run. And this is often the demand gen stuff that you're running, whether it's paid media or events or account-based marketing or whatever that you're doing. Then you need the content to support that work in the form of website content, assets that are required, any sales tools, etc. And then there's customer marketing work that needs to be done where there's cross-sell, upsell, account expansion type of opportunities. And then finally, once you identify all those opportunity areas, you need the right resourcing. And this is where you need to have the right data. And we haven't talked about data yet, but it's a critical piece of getting all this right to measure how well things are working so that you can figure out what to scale up, what to scale down. And then you want to translate that into how much budget you ultimately need to do all of this work to get to the revenue projections that you want to hit. And what we find when we come into companies, if we were to kind of scorecard them across these boxes, they're maybe good in some or strong in some. They might be a 5 out of 5, let's say in sales enablement, or 5 out of 5 on customer marketing, but they're really weak on their go-to-market strategy, or they don't have enough content, or they don't have enough product marketing. And so our approach is to kind of start at the bottom of the pyramid and slowly build sophistication, but work through these layers as quickly as possible so that you get to that revenue growth outcome in a reasonable time frame.
Yep. And from what I've seen with the companies that I've worked with, a lot of them jump straight to demand gen and brand and content, which logically makes a lot of sense, right? But I feel the foundation piece sometimes is missing. And when I have seen that, I've seen it show up as vague positioning, not really targeted, maybe inconsistent pipeline. From your experience, where are you seeing companies really get stuck in this pyramid, and how does that impact them both in terms of growth and evaluation and exit?
Yeah, I think the example you used of jumping to demand gen is one of the ones that I see all the time where people jump to tactics. They're like, well, we need to ramp up our SEO traffic, or we need to run more paid media campaigns or something like that. And then they launch things and they don't work. And the reason for that is the foundational work isn't done. And I'll give you, let's use a fictional example like from the book to just kind of illustrate this. Like let's say you're a company in the project management software space and you're doing general project management demand gen work. You are now competing with Trello, Asana, Jira, and all the heavy hitters in that space. But if you were to do your time and segmentation work and your product marketing work and you do your customer analysis and you uncover that the best fit customers for your tool are actually professional services firms like law firms or architecture firms or engineering firms that are billing for their time, they have invoicing needs, they have additional requirements beyond just project management that they're using your tool for. Now you shift the market away from general project management to enabling professional services firms. And that changes the demand gen programs that you would run because you might find that your five biggest customers today are the five biggest engineering firms in the world. And now, how many other large engineering firms are there? Maybe there's only 200 of them in North America. So we need to build a dedicated go-to-market to target those 200 firms with the right content, with the right campaigns, and the right programs to get them into our pipeline. That's very different than a general inbound marketing campaign where we're running ads for project management software and now paying $50 a click and competing with all these other providers that are kind of in that space. So I think as you nail the bottom foundational layer correctly, then the next part about that is, and the go-to-market strategy piece that's worth mentioning is also knowing your price point and the size of deal that you're going after. And the larger your sale or the average deal size, the more opportunity there is for you to leverage certain channels. So, for example, if your average deal size is 100,000 plus, we can now invest a lot more to acquire a customer because we can break even on that CAC within the first year. Whereas if our average deal size is only, let's say, $2,500 per year, now we're quite limited in terms of which channels we can go after. So things like SEO are super relevant the more transactional our product is, and they become less relevant the more enterprise our product is, because the more enterprise a product is, the channels that work the most are word of mouth and customer referrals and things like that. So nobody's actually necessarily searching for an ERP to manage a large hospital on Google and making a decision in a second like that, right? So knowing which channels are relevant and who you're kind of going after and your deal size, all of that influences which channels you end up focusing on and then how much budget you should be deploying inside those channels.
That's great. And you answered my next question a little bit in your last statement there, but this could maybe be overwhelming for a SaaS executive to look at this and say, okay, where do I start? I start at the foundation, but if there were two or three things in this pyramid that a software executive, SaaS executive were to focus on in the next 6 months, what's going to drive the biggest value in enterprise value if they were to do a process?
Yeah, I hate to give this answer. It's a little dependent on the company that we're talking
Yep.
about, right? So if you are not clear on which segments of the market where you definitely have a right to win or a huge competitive advantage over your competitors, that's probably the first place to really nail down. And connected to that, then immediately as you define that, your product marketing and sales enablement really needs to be shored up and strengthened. And then I'd say the second thing is the go-to-market strategy that we kind of just touched on. And I can just explain this on a slide. We have it here a little bit lower, right here. Like depending on the size of deal that you have, certain channels become more relevant and really having a deep understanding of what is the market that you're in, what is the total addressable market, and which activity should be most relevant to you. So, for example, if you're targeting the largest 600 hospitals in the country, it's probably ABM and customer marketing that's going to move the needle for your business the most. If you're targeting anybody that can use project management software, then you got to go more inbound and paid media and SEO and things like that to drive volumes and be more efficient from a self-serve standpoint. So I would say that's probably number two. And the third thing is more than the programs, because the programs are interchangeable. I'd say it's really getting the data right. And the data being where are you spending your money and being able to track your spend all the way through to closed won revenue. And that's in a big way what determines how efficient your programs are. And I can expand on this just to bring this to life for folks is what we find in a lot of companies is that they don't have a clear understanding of where they're spending their limited marketing dollars and what is the impact on close one revenue all the way through to the bottom of the funnel. They may have like some high level idea, like we spend $2 million on marketing and roughly we closed 5 million in bookings last year, as an example, right? But what we don't know is which avenues or which channels actually drove that business. So at a foundational level, what you need to do is be able to articulate what's working and what's not working and how much revenue came from each thing. So the first level is to just at a all the key funnel stages, knowing what are our metrics across the board. And companies in general will have these kinds of numbers. And what we're trying to figure out is how many demos are required to close one deal, because we're trying to figure out our full funnel efficiency and our current conversion rates. And that also allows us to kind of figure out what is our acceptable cost per lead. Especially if we have like a threshold, like, hey, we want to break even on our cost of acquisition in 12 months, then in this example, we can spend up to 429 bucks per lead to break even on our spend. And that answer is critical because it helps us figure out which channels are performing well and which ones are not performing well. So in this example, we have a column for acceptable cost per lead for that channel, and then the actual cost per lead for that channel. And you can see that some channels are kind of upside down, where maybe we're spending too much in some areas and we're spending too little in some areas. So for example, physical events, we're spending too much, and in paid media, we're not spending enough. And so that immediately becomes an opportunity to optimize for, to maybe even reallocate existing budget. And one of the things that we hear as complaints from companies is that, or at least marketers, they feel like they don't have enough budget. And one thing I try to impress upon folks, and I'm going to zoom back up here, is that the process to scale pipeline and predictability and just marketing in general is number one, you want to stop things that are inefficient. And number two, you want to reallocate to things that are efficient. But because companies don't have the right data framework to measure that, you can never do the first two steps. And
Mhm.
so having that framework allows you to execute on that. And then as you discover what's actually efficient, then the third question becomes like, what is the efficient frontier for this channel? For example, if events are going really well, how many more events can we get to? That's like a very, very natural question to ask, right? So people get there with sales people, but they don't get there with marketing programs as much. And so if we try to figure out that efficient frontier, there's probably 2x or 3x we can spend on specific channels. And just by doing these first three steps, most companies can find 20 to 50% pipeline. I've seen even more than this, or at least EBITDA that can be found in terms of efficiency, and you kind of take a zero-based budgeting approach. And then finally, you get to number four, which is where you're testing and optimizing for new channels. But I'll kind of stop there to see if you have follow-ups, and then we can also jump around more.
I don't have any follow-ups, but I think this is a good transition to my next portion of my questions because you're diving a little bit into sales and marketing alignment, which is really important because top sales reps do know their ICPs cold. They know who to sell to, they know the customer pain, but that's isolated in sales from what I've seen for the most part. And it doesn't really make its way back to marketing. So everything that you just went through is kind of a black hole for the marketing team because sales knows, marketing doesn't. So what does great sales marketing alignment look like in practice? And then how does that translate to valuable pipeline for the company?
Yeah, I think it's along the same lines of what we've been talking about, is that it needs to start with the data side. And I'd say one of the major, even though these ideas have been around for a while now, the in a lot of companies, the marketing accountability often stops at the handoff. So we have generated a certain amount of leads, and like one of the most egregious things I've seen inside companies is like, I'm sure people here on the call have seen it. It's like marketing will go to a trade show, scan a bunch of badges, hand off the conference list to sales, and say, "We got you a bunch of leads by going to this event."
Right.
And sales calls those people, and they're nowhere close to ready to buy. And so that's an example of complete misalignment because marketing is not accountable to the quality of leads and the revenue that's being generated. So one of the first things to change is to build this data framework and to have the accountability where every channel is being measured all the way through to revenue. And by doing that, we're telling marketing your spend is going to be held accountable to how much revenue you're generating. And we're not just going to let you hand off the lead to sales and then put the blame on sales. So at that point, it kind of becomes like uh, a necessary relationship that you kind of have to go for. So in my opinion, if sales says you gave them a bad lead, I personally believe sales because sales is accountable to revenue and they have quotas. And if they hit their quota, they're going to get their bonuses and OT and all that kind of stuff. So if they're saying it's not a good lead, odds are it's probably not. And so with that feedback loop, we have a way to kind of constantly measure, are we bringing in the right leads for sales? So let's say we were running a campaign, coming back to our example, to engineering firms, and sales told us, hey, these are good leads. And then we also gave them leads from consulting firms, and they told us that consulting firms don't convert. That's a qualitative feedback loop to go back and adjust our spend on the campaigns where we're targeting the consulting firms and maybe directed more towards the engineering firms. And then at a cultural level, the budget that's being given to marketing needs to have revenue attached to it, revenue targets attached to it. So for every single, excuse me, I'm jumping around on slides here. I'm going to find the right one. But for every single area of marketing spend, we need to know what is the right revenue expectation for this channel. How many leads should we expect? How many opportunities and how many close won deals? And then we need to have a monthly, quarterly, and annual feedback loop to see if we actually kind of hit those numbers for a particular channel or activity area. And if we don't, then that becomes marketing's accountability to kind of improve. So I think with the data side, you can do a ton of make a ton of progress in building alignment between those two teams.
I totally agree. And it's almost funny how much you see marketing and sales pitted against each other in a lot of organizations. But when they work together, they could benefit each other tremendously. And then the growth of the company obviously is a positive consequence of that. And you've been talking about budget reallocation and shifting spend from low quality channels to higher ones. In a process, what I've seen is that when a company can show where the pipeline's actually coming from, buyers start to lean in, investors start to lean in because it shows control, it shows maturity, and we keep going back to this, but repeatability and predictability. So when you're looking at a budget, how do you approach diagnosing waste spend and allocating budget in a way that improves not just the growth, but deal readiness?
Yeah, so I think one of the things, and I'm going to jump forward again, is one of the things to kind of think about is that um, what we kind of have to impress upon the board, the CEO, just everybody, including the entire executive team, is that let's say we have a certain bookings target for a specific year that needs to be reverse engineered. What ends up happening in most companies is that the budgeting exercise is more of like it's more like a math exercise where we figure out what we've spent on marketing historically and we kind of see what or marketing and sales and just in general, each department how much is being allocated. Maybe some type of adjustment is applied to that. And then we have new targets set for the year. And to some degree, this works because it's a top-down forecast. It's based on historic numbers. It gives you some sort of an idea. But what the big opportunity that's missed there is that there's no bottoms-up forecast created inside these organizations where there's a ton of insight and intelligence that sits inside each of the channels, each of the activity areas, and that we can use to build a better forecast. And so, as an example here, like if let's say we have a $1.45 million bookings target, how many wins do we need from marketing to actually hit that target? What percentage of the bookings need to come from marketing? How many opportunities, how many leads, and what does paid media, for example, need to contribute to that? What do other channels need to contribute for us to actually be able to hit those targets? And you kind of need to do this exercise for every single channel that you're investing into to help you understand what is the right sized budget for this organization. And the better your data model there, the more likely you are to hit your projections. When it's top down, I've seen companies miss their targets often because there's not enough of an understanding of how much flex there is inside specific channels or how efficient or inefficient a particular channel might be. And so a ton of opportunities are missed. And you can actually leverage your existing budget a lot better by doing this as well. And it doesn't always have to be that the budget goes up. In this case, we're showing that the budget's jumping from, let's say, 3.7 to 5.2 million. There are situations where we've come in and we've audited small and large companies, and we've found that the budget can actually come down without any impact to pipeline and revenue because there's just so much waste inside their current marketing spend. And the reason for that is they just haven't built the data framework to be able to measure those things. So the more bottoms up the forecast is, and the more you truly understand all the stages and what is contributing to that, the more likely you are to hit those projections and have the right budget.
Hmm. And I would assume that this does take a bit of time to clean up the marketing engine, have sales and marketing alignment. We at SCG, we're talking to prospects very early on before we're going to market, sometimes months, sometimes years, to target exactly things like this. Where are areas that you can clean up to prepare yourself best for the most successful outcome when you do go to market? And I'm always telling founders, software executives that the best exits are designed. And you've been on the other side of the table, you're helping dozens of companies get the best successful outcome. So, from your perspective, if a founder is a year or two out from an exit, what is one marketing move that they should prioritize now to drive value later when they do go to market?
Yeah, I'd say instead of like it being a specific tactic, I'd just say changing the approach. So just looking at this line that we have on the screen here, it's being scientific about your go-to-market efforts overall. So knowing what is the right size budget, what are our growth aspirations, what are the numbers we need to hit so that we can get to an exit, for example, and then how many deals do we need? Working backwards to what does each area of the business need to contribute in order for us to get there? And that could be net new revenue from net new customers. It could be upsell or cross-sell revenue. It could be expanding existing accounts. It could be pricing increases. What are all the things that you can do? And what is the role that marketing has to play? And what is the role that sales has to play? The more you can engineer that and understand the contributions that are required, the better you can kind of figure out at a tactical level what needs to be done in order to hit those numbers. And so it's building that discipline inside companies and having the right data model and actually setting up the right data infrastructure to collect the right data to be able to make some of those decisions. And I think a lot of the people, if they're looking at a transaction 1 year or 2 years out, that's a great time horizon to kind of set the right expectations for this because these kinds of transformations don't happen overnight, right? What I'm talking about here, when we go through an engagement with a company, it takes 3 to 4 months to transform their marketing organization. And then they kind of have to implement things, and then there's changes along the way. So it takes 6 months to get to a good place. And
Mm-hmm.
and I'm always educating founders on that and companies on that is that 6 months is a very reasonable amount of time to completely change how your business operates and what works and what doesn't. And if you think about just anything hard that you're trying to accomplish, like if somebody told you you could lose 50 pounds in a week, you wouldn't believe them, right? So, right, it doesn't make sense. So I think building a marketing engine is very similar in that it's a long journey. You kind of have to invest in it long term, and you're going to wake up in 6 months, 12 months time and have the right data model, have some more predictability inside your business, and have more growth to kind of show for it, which kind of increases your enterprise value.
Absolutely. That's great. And I have one more question. It's a two-parter, and then we will move on to questions from the audience. So for those listening, if you have questions, please submit them now. That's the next part of this discussion here. But if you were to give a piece of advice to a SaaS leader that is trying to make sure that marketing becomes a multiplier and not a liability when it comes time to sell, what would that be? That's the first part of the question. And then the second part of the question is there anything you and I haven't discussed on today's call that maybe you do want to highlight that you think is important to the audience?
Yeah, I think a couple of things. So when I often do these talks, I end up focusing on the process and the data and all these things because they're essential and they're missing inside of a lot of companies. I think one additional thing I think founders should kind of keep in mind is that generating demand is a hard thing to do. It's not just, let's say, launching a set of ads and just setting it and it kind of works. It is a holistic approach to the whole business. And someone needs to think about that. And in my opinion, that someone should be the CEO, right? And it can be the CMO, but you need a really strong CMO that understands that, or the CEO is kind of directing that person. And when I say holistically, like great go to market looks like someone that truly understands the product and all the things that need to be done there, connects it to the message and how we want to kind of compete in the marketplace and establish the right positioning, and then connects to the programs that we actually run that are kind of out there. And I often see misses because efforts inside companies are pretty siloed. And the sales team is kind of doing something, marketing team is kind of doing something, but no one is holistically figuring out what's the strategic position of this business in this marketplace. So I'd say just that as an idea, I think for CEOs to really lead that and be the true leader of that is a critical, I think, variable to making sure this is successful. If it's kind of just offloaded to the CMO, or like a VP of marketing, the odds of success do go down because the CEO is not as involved in that process.
Mhm. That's great. And it actually leads to the first audience question, which is interesting. But the first question we have here is, how big does your marketing team need to be for this all to work? And do you need a full-time CMO or marketing leader?
It's a great question. So we actually do have slides on this, and we didn't touch on that. Give me 1 second. So one way to kind of think about this is that resourcing, we talked about the budgeting side, but the people side is a critical variable, because if you don't have the right marketing leader, a lot of the stuff that I'm describing is going to be hard to do. And even if you have a good marketing leader, but they don't have the right resources underneath them, it's not going to work either. So one of the things to figure out is like if you think about the data, you got the data in order, you now know where you want to deploy your budget or how you're going to reallocate and what your roadmap looks like. Now, who are the people that are going to actually execute on these priorities? And we started this off by saying underdeveloped or immature marketing organizations don't have enough people. And I'd say that would be a good place to audit. Like, first, do you have the right people in the right seats? And do you have a lot of these roles kind of filled out? And if you're a smaller company, maybe you don't need this big of a marketing organization. This is what I would call like uh, level two or level three kind of marketing organization. At a base level, if you're less than 5 million, you need two or three people to run the org. And maybe you can put the same person's name in multiple boxes here. And as it scales, it just looks like the same team kind of duplicated or multi-product line or multinational kind of teams. But you want to know, do you have someone that can lead all your content efforts, that can lead your programs across the life cycle, your buyer journey, SEO, event marketing. You have someone that can handle PR and comms, someone that can do paid media, someone that can do ABM. All of these different skill sets are different. Someone that is really great at SEO may not be the best person to create product marketing content for you because that's a very different skill set. So I'd say taking the time to kind of audit your current team and thinking about the work that's been described here, is that team capable of doing this, or are there gaps on your inside your existing organization? And if there are, I would build a hiring roadmap to figure out which roles you kind of want to staff up with next in order to be able to execute on this, to be able to actually do a lot of the things that we've described.
Great. Okay. Question number two. How do I determine the acceptable cost per MQL?
Yeah, so I can scroll back up here just to touch on this. So I think if we were just starting at a high level, right, you look at your conversion rates, and that should tell you how many demos do you need to get close one deal. And if your close one deal, let's say, is $100,000, right? And it takes you 25 demos to close one win, then you can spend $4,000 per demo and still break even in 12 months' time, right? Just to use basic math here and not necessarily accurate in all circumstances, but roughly that's what we're talking about. And then you use that as your baseline to judge all your activities. So I'd say the starting point should be just to understand holistically in the last 12 months, how many deals did you close? How many opportunities were in your pipeline? And how many conversations or demos or MQLs or whatever your terminology is inside your CRM? How many of those did you have? And that gives you a rough idea. If you want to do cohort-based work, you can do it that way. But just to get a ballpark, is it 1 in 25? Is it 1 in 50? Is it 1 in 10? Depending on the type of deal that you're closing, the answer will be different. But that should inform how much you should be able to spend to acquire a lead in the first place.
Great. Interesting. The next question is pretty specific, but I think this is a good question to ask. We have a broad range initial ACV, $2,500 to $50,000, And we're finding that a hybrid PLG SLG approach is better than a pure SLG approach. But our sales team is somewhat resistant and wants to just sell the $50,000 deals. Any suggestions on how to approach this and perhaps motivate the sales team? I like this question a lot because I've seen this in a lot of my deals too, that a lot of the sales team wants to chase the elephant. Sometimes it's good for the organization, sometimes it's not. So I'm interested to hear what you have to say, Shiv.
Yeah, so um, I'll answer this in a couple of ways. One is, and we see this all the time because companies have either more than one product line or they have more than one segment or market that they're kind of going after. And so you inevitably get caught in this place where some of your customers have a lower deal size and some of them have a larger deal size. The answer is actually both in most cases, because what you need is a strategy for the lower end of the market and a different strategy for the upper end of the market. So your sales team, if let's assume that like what you're saying is actually it's completely accurate and they're regularly capable of closing a $50,000 deal because it is your ICP, then we need a dedicated go-to-market for the larger deals, and we should be doing more ABM or one-to-one outreach or sales-based outbound there. Because if you were to use your sales resources on the PLG side, your cost of acquisition would be too high if you factor in the sales salaries. But the sales folks can do the outbound for the larger deals. And if they close one or two deals a month, for example, and on the PLG side, you have more volume, they're both contributing to your growth. But each of those segments or strategies requires its own go-to-market. And so this is the second half of the answer, which is it depends on how big you are. If you're a smaller business, then it's very easy to get distracted by different segments because you have limited amount of resources to put into product marketing, put into demand gen, and put into some of these other areas. And so there likely needs to be some sort of a trade-off or prioritization that ends up happening. So you might say, hey, we are going to focus on PLG, but then organically we're going to get inbound larger sales deals that come about. And those are the ones that we'll refer to the sales team, but we're not going to proactively chase after larger sales deals because we don't have enough sales reps to fund that, or because we have to make this trade-off, I'd rather have my sales reps nurturing the ones that are already kind of coming inbound to our organization. But if you're a larger company, like let's say you're 50 million in revenue, I would definitely say do both because there's going to be a ton of revenue that sits inside both of those segments.
Yeah, that's great. Super interesting. This next question is one that it's about allocation. How do you determine if a deal came from sales versus marketing? If the two departments are aligned, it seems like there would be a lot of overlap. And we were actually having this debate internally at SCG because it's tough. It's a tough thing to measure. So Shiv, what do you think about that?
So there will definitely be overlap. I think there will be for sure. I think there's a few ways to look at this. One is looking at just where did the deal originate? What is the first touch? And some of it will be outbound driven or sales activity driven, relationships, referrals, etc. And others will be inbound or marketing activities driven, like a trade show or inbound marketing, SEO, paid media, etc. So I would definitely have that view to say, what is the point of origination for this deal? And then you can also ask questions like, how did you kind of hear about us? What led you to come with us in the first place? And that gives you an additional layer that helps you justify who kind of gets some of the credit. The second piece of this is that there will be situations where somebody comes in through outbound, but they previously read something that the marketing team wrote or met you at a trade show or already did some type of interaction or attended a webinar, for example. In those cases, I find that multi-touch is also valuable because it kind of gives credit to both things and you're kind of being fair to all sides. I have a slightly different view because you can kind of over-engineer this
Mhm.
till you're blue in the face. And there's actually no right answer because customer journeys are not a straight line. They're kind of like a ping pong ball, kind of just like going all over the place. And so it's more helpful to just try to triangulate the truth, which is, did sales play a role here? Did marketing play a role here? And are we creating the right environment to close a deal? Because certain elements of your go-to-market activities will touch or influence a prospect more than you realize or more than the data suggests, and vice versa. So by taking that more triangulation standpoint, you're allowing it to be more of an sometimes an art and a science, which is important. Like for example, I run a podcast, I've written a book. If you were to kind of look at our demo submission forms, none of them are going to give credit to the podcast or the book. But then I end up on sales calls and people have the book on the in their hands, right? So how do I kind of give that credit inside of our CRM? It's more qualitative. So I'd say try to do your best to triangulate the truth and kind of just make a judgment call and just trust your judgment on that.
And do you think, and this is a question coming from me, where do you think that should be coming from? Is it a pull from the top, the CEO, or is it push from the sales and marketing team?
I think I think marketing and sales need to, it's better if they kind of align on that and evangelize that inside the company. I think it's way less helpful when marketing and sales are trying to take credit
Hmm.
for something that has happened and more just recognize like what is actually happening. Even if you think about how you yourself would buy something. Let's say we're gonna go buy, if you were gonna go buy a pair of shoes for an event, the number of people you would have probably talked to, the number of articles you probably read, the number of stores you'd have gone to, you're gonna do so many activities along the way before you make that decision, that it's kind of silly to try to give one of those activities more credit than another.
Hmm.
And I think when we're talking about an enterprise sale, the number of touch points are even more because it's not a 100 or 200 or $500 sale. We're talking about 10,000, $100,000 deals. And so I think if marketing and sales, and especially the leadership there, can get aligned that you're on the same team, there is no trying to take credit. It's like, what is the truth? What is the actual truth? And trying to articulate that for the CEO and board, that shows a level of maturity inside the leadership to be able to kind of navigate that. And then from the CEO, I would just try to evangelize that same principle is to say, I care less about who gets credit. I care more about what's accurate so that we can deploy our budget into the right areas.
Hmm. Yeah, it's the whole rising tide floats all boats, right?
100%. Yeah.
This next question is one I like a lot, because we are often working with founders or CEOs that maybe have not gone through a exit event before, or they're bootstrap businesses and they're doing a lot by themselves. So, as a founder with limited time, how should I prioritize working on marketing versus working on other aspects of the business, e.g., the financials, when I am preparing for an exit?
Yeah. So I definitely empathize with that. Obviously, founders have like 100 things that they have to work on, and like for example, legal, technical, and everything else. I would just come back to the principle of a business that is worth being acquired is one that's worth continuing to operate, right? So yes, it's important to do some of that admin stuff to help you get acquired, including building financial statements and projection models and stuff like that. But if you have a really healthy go-to-market engine, uh, in diligence, that's going to show more in your quality of earnings than having the perfect spreadsheet of your financials. So I would say prioritize the financial health of the business, and then get help on the admin side to help you get all that stuff together.
Great. Yeah, in our processes, we say focus on the business, focus on the growth, and where you can make some efficiencies and some changes to make your business that much better is where you should focus your time. So aligned there. Next question is it possible to accelerate how fast you move through the steps to marketing sophistication?
Definitely. I think the variable there is how much focus the team and especially the CEO gives to it. And that's why I brought that point up earlier, is that the CEO really needs to be the leader of this kind of a transformation because to go through, let's say we're trying to go through all these different areas and there's misalignment on the right segment to kind of go after or the right messaging and positioning to have. The tiebreaker is the CEO, and you can kind of move past certain things a lot faster if the CEO is kind of leading it. So I'd say the right time horizon to kind of think is minimum 3 months to zip through this, but you need to have the right people involved. And the CEO doesn't need to be the one on every single meeting, but they need to be the sponsor behind this to say, we're going to do this. And they kind of push the marketing leadership and sales leadership to adopt this type of a framework.
That's great. And I think we have maybe time for one or two more questions here. So, which metrics are the best indicators that your marketing is becoming more sophisticated?
Yeah, that's a great question. I would say the ones that we talked about right off the top, which is how much pipeline are you generating? So if your marketing generated pipeline gets to be above 25%, in general, that means you have a more sophisticated engine. But I'll add some caveats to this. One caveat would be if you're a product-led growth business, your marketing contribution to pipeline should be like north of 80% because your deal sizes are too small, and the only way to find customers is through marketing, right? So in those cases, it's kind of a false signal. So what you really want to figure out is like what's the efficient frontier, like how much pipeline should you be generating for your particular size at that business. But just as a general rule of thumb, if you're somewhere between 25 to 50%, that means you're building more sophistication for sure.
Great. And this last question here, I think we have time for, it goes back to the answer that you just had before this last one, but how long will it take for marketing to work to start impacting my exit valuation?
Yeah, so it's a slightly different answer on this one, I would say,
Mhm.
which is that like this is the ideal state, right? Like we drop a dollar in today and it creates, 5 or 9x enterprise value almost immediately. Um, so the 3 months that we're saying to transform that you invest, then you kind of have to give yourself time to implement roadmap items, and you might be doing that along the 3 months to collect more data, but giving yourself a full 6 month window that includes that initial 3 months that starts to give you the right feedback loops on where you're investing. And then you should have the right data model to then be able to figure out how much to scale. And so from month 7, month 8 onwards, you're scaling a lot faster. So by month 12, you have a ton of insight and you're making a significant business case to ramp up your marketing spend. So I would give it a full 12-month cycle but the second 6 months of that is where you're already seeing a ton of return. And then year two is when you kind of put all your resources behind the areas that are working and you start to see a lot more return as well.
Great. And I think that's all we have time for in terms of questions. But to follow up on the last thing you said, Shiv, that's why it's always good to consistently be touching base with experts who, have been through the M&A process before. So you can be looking at these metrics. What can you fix in the next 12 months? And when you're feeling, hey, I want to continue to operate this business and you're feeling like you don't want to sell, is the time to start having these conversations. So you could see where you can pull some levers to increase your valuation and have a better outcome. So that's great. Thank you. So I think that's all we have time for, as I mentioned. So Shiv, if we could go to the last slide here.
Yep.
Fantastic. As we wrap today's discussion, I want to extend a sincere thank you to our guest, Shiv Narayan. Your insights and experience is so valuable, and I'm so excited to do this webinar with you. We're grateful for your time. And thank you to everybody who joined us. We truly appreciate your time, attention, and thoughtful engagement throughout the session. We hope that you're walking away with a clear understanding of how marketing can play a strategic role in driving growth, aligning teams, and setting the foundation for success. If there's any questions that we weren't able to get to, or you do want to continue the conversation, please don't hesitate to reach out. And when you exit the webinar, a short survey will pop up where you can share feedback or submit any additional questions that you have. A recording of today's session will also be sent to your inbox. So thank you again, everyone, and enjoy the rest of your week.